Okay, let's have a look now at annuities and perpetuities. And what I've put on the screen there is what we call a discount factor at 10% for 1 year. So it's 1 divided by 1.10, 10 being the percentage, and it's only once being the year for 1 year. So 1 divided by 1.10 is how you get your discount factor of 0.909. You see that in your discount tables. If it was 10% for 2 years, it would be 1 divided by 1.10 twice, because it's 2 years. So 1 divided by 1.10 squared, which is 0.826, which you will see on your single discount factor tables. If it was for 3 years, it'd be 1 divided by 1.10 3 times cubed, which would give you 0.751. So they're your single discount factors. Now, if you added those three down, the 0.909, the 0.826, the 0.751, which are single discount factors, you will get a cumulative discount factor of 2.486, and we call that cumulative discount factor an annuity. Okay, so you sometimes see it called a cumulative discount factor, and all it is as you can see, the other discount factors added together. So that would be the cumulative discount factor, or the annuity, for 10% for 3 years. So that's all well and good, you're thinking, but how on earth am I using that in the exam? How does it all work out? Well, here we go then. Let's say you get told you get $100, you have to pay or receive $100 every year for 3 years. And you want to take into account the time value of money, and they tell you that the discount rate to use is 10%. So we can use the figures we've got up there. Okay, discount rate 10%. Well, what we could do then, we could say, right, the one at the end of year 1, all I need to do is times it by the discount factor, and that makes it 90.9. The 100 that I receive at the end of year 2, I times it by the year 2 single discount factor, which will make me 82.6. The one I get at year 3, similarly, I'll use the year 3 discount factor, will get me 75.1. And if I add all those down then, that 300 that I've received, taking into account the time value of money, taking into account the discount rate, would give me 248.6. But wouldn't it have been easier if I had just taken the 100 and times it by the 3 years for 10% discount factor? And that would have got me 248.6 straight away. So it's basically using an annuity is just a time saver, so you don't have to do each individual year. But the key is you can only use this when it's the same amount each year, hence the word annuity, when it's the same amount each year. So the 100 was the same every year. So instead of doing it on each individual year and discounting it all down and then totaling it up, just use the annuity, just use the cumulative discount factor for how many years and the discount rate. It'll get you there quicker. Okay, moving on to perpetuities. Perpetuity being an amount that you're going to receive forever. So best explained by an example, I guess. So let's say that this time you're going to receive 100 every year, not for 3 years, but every year from the end of year 3, notice, from the end of year 3 onwards. So first of all, you need to work out, well, the question is, what is that worth today? Okay, receiving 100 for every year in perpetuity forever from the end of year 3 onwards, what's that worth today? Right, well, first of all, you need to work out what the perpetuity is worth. And that is simple. It's just the cash that you're going to receive or pay, which in this case is 100, divided by the discount rate, which in this case is 10%. So the perpetuity is 100 divided by 0.10, which is 1,000. So that's how much the perpetuity is worth. However, it's not worth that in today's money, because I get it from the end of year 3 onwards. So therefore, I need to discount it down by 3 years. And if you remember, divide by 1.10 to the power of 3. So discount it down, and it's actually worth 751. And that's the figure that you need.